Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. I'm here with Ben Nye today. We're going to do a quick recap of the conference Ben went to last week, CFA Institute in Hong Kong. So I think he's probably recovering from jet lag a little bit still. But we're going to go over kind of some key points of the conference, go over a couple quotes. He's got some really good quotes that he heard from keynotes there. So let's just dive right in. Ben, if you want to give us a little bit of background on how the trip was, maybe a nice little anecdote from Hong Kong there. And let's dive right in.
Yeah, well, first, quick plug for the CFA. They put on this conference. It was the first global CFA conference that I'd been to. It was the first time I'd been to the Far East, really anywhere over there. So for me, it was a new experience in many respects. First of all, a 14-hour trans-Pacific flight after getting back to the West Coast. And then also experiencing a totally new place but still with a lot of similarities to the Western world that we actually have as well. I went to the Temple Street Market, which is where you have to haggle massively for any off-price rip-off goods.
Did you get any good stuff?
Yeah, I got a Hugo Boss wallet for $8.
There you go.
It was definitely
steal.
authentic. Definitely authentic. It was one of those things where you just kind of had to do. If you don't buy some rip-off good in the Temple Street Market, you haven't gone to Hong Kong.
You didn't even really go if you don't. All right, cool. Well, I got a couple quotes here. I want to dive into some of these because reading through these, I like a few of them. This is one of my favorites here. Stephen Iseman said, "I don't see any financial crisis in the near future." What are your thoughts on that one?
Well, it's interesting. I mean, Stephen Iseman was, if anyone has seen The Big Short, Stephen Iseman was played by Steve Carell in that movie, and he was one of the few people portrayed in that movie who actually saw the whole crisis coming with the housing industry. So a little bit of background on Iseman is that he actually started as a mortgage analyst in the 90s. So he had seen this movie before, and what he saw in 2003 was that a lot of these characters were coming back. A lot of these bad actors from previous crises were coming back. And this time, with all the leverage in the system, it just compounded the issues that we'd had before. And so in 2006, he started saying, hey, here's my chance. So he starts going short and betting against it. And he said the trade really never went against him. He was always ahead in the trade, which is kind of nice. The trades where you have issues is when it goes against you for a few years if you're too early. And then you really, you start questioning yourself. Investors start questioning you. But that didn't really happen in Iseman's case. He was always kind of on the right side of it. So he got that one right. And that's why a lot of people find it meaningful when he comes out and says he doesn't see another big financial crisis brewing. He doesn't see a big systemic issue that's currently in the markets. He did say that there was some concern about Canada housing, and he said that would have to correct at some point. But he doesn't think that poses a systemic risk to even the Canadian economy, let alone the global economy. So right now, Iseman is he's heavy in financials, and he's heavy in technology, and those are the areas of opportunity that he's seeing, and it's importantly on the long side, not on the short side. So take that for what you will. Obviously, Iseman saw the last crisis coming, but it's tough to see two major crises coming. And the thing about a crisis is that you don't see it coming.
Right. Did he pitch any stocks?
He didn't pitch a major stock, but he did like the financials. He implied that he's pretty heavy in a lot of the banks. And he does like some of the technology, some of the disruptors. So by implication, it seems like he may even like something like Amazon. I'm not sure how value-oriented he is, if Amazon fits in his model. But in terms of someone who's actually disrupting an industry, Amazon fits that bill. So you would kind of say that he might be long Amazon. Full disclosure, we do own financial stocks, we do own technology stocks, and we do own Amazon.
All right, moving right along. Another great quote. One Belt, One Road is as much about influence as it is about infrastructure. Give us a little insight into that one.
Yeah, so I think one of the things that I was really interested in as I was going out to that neck of the woods was that China right now is engaged in this massive One Belt, One Road policy. And what this is kind of a rejuvenation, a renaissance, if you will, of the old Silk Road that they used to have. So this was this huge trading relationship that went from China all the way to Europe. And what China is trying to do now is that they are trying to revive that. So how are they going about doing that? Well, they're building rail, they're building road network, but importantly, they're also plugging in energy infrastructure and other things like that so that you'll have this corridor of economic development. I think $900 billion has been earmarked for this project over the next number of years. And China is really trying to, in terms of that quote, this view that it's more about influence versus infrastructure. The more China develops and the more China comes to a government, say Pakistan, and says, hey, we want to build a railroad through your country. Will you let us? We will pay for it. We'll employ your workers. All of a sudden, you get into this transactional way of thinking where China is essentially, they have the leverage. They're being the kingmaker. They are saying to Pakistan, we choose you. Aren't you lucky to be working with us? And from then on, Pakistan will have to do what China says. And the same is true for, take another example like Nigeria. So in Nigeria, what you have is a very, very weak currency. In fact, they have multiple floating currencies in Nigeria, currency rates. You have a market rate and then you have the government rate. And what China does is say, hey, even though the government rate is a lot stronger than the actual market rate, we could get a better rate in the market. Nigeria, we're going to go to you and we're going to allow you to swap some of your currency with our currency. So all of a sudden, Nigeria gets $2.5 billion US worth of Chinese currency, which is a lot of money for them. And China, again, trying to exert that influence. Nigeria now owes China something. And that's really what this quote means, is that China is looking to buy influence with its One Belt, One Road policy, which is really insightful, but it should be concerning for a lot of Western politicians.
All right, we got another great quote from Daniel Kahneman. So, narrow framing leads to exaggerated loss aversion. People need to think more broadly about losses.
Yeah, so I think this is a great quote, and I think it's something that anyone can apply, not just in finance. So, Greg, you'll probably prove me wrong on this, but Kahneman did this experiment with the audience, and he said, you flip a coin, and you have to pay a $100 entry fee, okay? If it comes up heads, you win. If it comes up tails, you lose $100.
Okay.
How much would you have to win in order to take that bet? It's $100.
Yeah. I don't know. That's a tough one. I need some pretty good odds on that, because if we're talking about one flip, then that's 50%. I don't know. I want 10-1 on that.
You want 10-1? Wow. So it's interesting, actually. The average person would say 2-1.
Sure.
A lot of people in finance who are trying to be, more rational, they'll say like 1.6-1, 1.5
sure.
to 1. But I'm glad you kind of led with that thing, because you only get one flip.
Right. I can walk away from that easy.
Now let's say you get 10 flips.
Okay.
How much would you have to win? What would the payout have to be?
I always want 10-1, but yeah, it doesn't have to be as much, but it depends on how I'm feeling that day.
But it would be less.
It would be much less. Yes. Yeah.
And that's Kahneman's point,
Right.
is that we often are very, very loss averse. We don't want to incur losses when we perceive that we only have one shot.
Right.
But when we perceive that we have many shots, we're willing to take more losses.
Right.
So in his way of thinking, instead of myopically focusing on one event, have it follow a policy throughout your life. So if you take a risky decision that should pay off, but does incur an element of risk, think of that in the broad context of over your entire life. If you assume these risks, what would the payout be? And he says that will allow you to take more rational decisions, because instead of thinking as of, I get one flip and I have to make money on it, think about it as, this is one flip. This is one risky decision in a lifetime of potentially risky decisions.
Right.
So in essence, although I'm not making a risky decision just because I'm flipping this 10 times, I am making 10 risky decisions in my life. And as a result, and because the payout is positive, I should take this coin flip even if it's at a much lower payout ratio.
Right. Right.
So I think that's an interesting way of thinking. Got to be careful that you don't take tons of and be reckless with the risks that you take. But even so, you want to be able to take good risks, prudent risks, and not be too concerned, require obscene payout ratios to take them.
Right. That's a good point. It's an interesting way to look at it. I like that analogy. I'm glad I could ruin it as well. So we got another one from Kahneman as well. When can we trust intuition? When we have expertise. When do we have expertise? When we're dealing with regular phenomena, have experience, and receive immediate feedback. What do you got on that one?
Yeah, so I think the key points are intuition we can almost always use, especially when dealing with people, because we know how people tend to react in situations. So if their reaction is a certain way, that informs our way of thinking. And we have this intuitive thought about what someone's reaction. Just makes sense. But this is what you need. You need regular phenomenon, which means that you have an expected response. You have immediate feedback, which means that you're not waiting a year or two. And you have experience with this, which means you have a long history with it. So by his definition, you cannot use intuition in finance because you're not dealing with regular phenomenon.
Right.
The financial markets are irregular, and therefore you can't have a hunch about a market, because you might think you have expertise, but expertise, to quote him, is an illusion when you're dealing with financial markets. You might think you have experience, but you don't really, because you're not getting that immediate feedback. If you get immediate feedback, your feedback in financial markets takes years sometimes to manifest itself. So by his definition, he says, you can't use intuition there. And I think we'll probably get to this as well. You should be using algorithms instead. And he said this doesn't just apply to finance, though. This also applies to things like radiology, and I have an example that we can touch on later. Physicians making diagnoses, underwriters, underwriting a policy. The variance is very wide among a lot of these judgments that are made, because there is this illusion of expertise and people trust their intuition when they really probably shouldn't be.
I like that. It's an interesting little triangle there where the intuition, the experience, and yeah, like you said, we're dealing with stock market, financial institutions that if everybody knew where things were going, everybody would be rich. It's just not the
exactly.
case. All right, got another quote for you from Andy Lapata. Receive without forgetting, give without remembering. What was he referencing there?
So he's talking about networking and the way you actually build a network based on real relationships. But to pull back a little bit, Lapata began his talk, and you're at a networking talk, and you kind of groan when you go into it because you're probably going to get read this same script, which we've all heard. And the guy starts from the very back of the theater, and he's introduced, and then he starts running down the theater, handing his business card, saying, "Hi, I'm Andy. Great to meet you. Here's my business card. Hi, I'm Andy." It does this whole dog and pony show, and I'm just thinking to myself, I got an hour of this guy. And I roll my eyes. I'm just like, I can't believe this guy.
I wish we had some footage of that.
Yeah. He gets up on the stage and says, "How many of you have experienced something like that before?" And we've all experienced it. Someone just giving out their business cards, collecting LinkedIn connections just to say they have a big network, talking about how many Facebook or Twitter followers they have. And he says, that doesn't mean anything. Yeah, if you can call up any one of those people and they will vouch for you and have your back, that's a powerful network. But he says, these people with 3,000 connections, they don't have that. So yes, he said, we're not going to go against building a large network, but we want the priority to be on building a network built on real, true foundational relationships. And he says the way you do that isn't a transactional way of thinking, because that lasts as long as the transaction lasts. That's like this China issue that we were talking about. If China is trying to buy leverage, and that lasts as long as China can continue to buy that leverage. How you really build the true relationships is if you don't really expect anything back. If you give without remembering, and if you receive without forgetting, meaning that if someone does do well by you, you make sure that, hey, I got to have their back too.
Right.
So I thought the whole that talk on networking was one of the better networking talks I've ever heard.
I like that. I know a lot of that networking stuff can kind of seem forced sometimes, and the way I look at it is that to get to that one person that really would add to your network, you have to go through all those pitchy, salesy, people that you don't even really need to talk to and waste your time. But unfortunately, you got to go through them. We got another one from Iseman here. Incentives trump ethics every time. I think that's a really interesting one.
I mean, Iseman was a king of hot takes in his talk. Another fun fact on Iseman is it was asked, how do you come up with investment ideas? How do you kind of see the future of where the stuff is going? And he said comic books. He has 8,000 comic books on his iPad.
Wow. And
he said that the comics predicted Trump's election. So,
did he give any reference? I mean,
he didn't go into a ton of detail, but so if you want to know where the S&P 500 is going, I guess read Garfield or something.
Read some comics.
Yeah. No, but his talk here, incentive trumps ethics every time. Maybe I'm just not quite as cynical as him, but I would say, only a Sith deals in absolutes. But
that's a hot take right there.
But what you have is that you want, especially when you're investing, you want the incentives to line up with what you want to see. Because I would say don't trust that someone's going to rely on their ethics. You can hope that someone is going to fall back on their ethics, but at the end of the day, if you're making a financial decision, look at where the incentives lie. And if management is being compensated for something like signing up as many mortgage applicants as they can, a la the housing crisis,
right,
then you should think twice about investing in such a company for the long term, because your incentives are not aligned with management.
Right. Yeah, you do have to kind of follow the money in a sense, in a certain way. So I'd agree. I'm not quite that cynical, but I can see how that, it's definitely a hot take. Got another one from Iseman as well. Choose a career that plays to your strengths and attributes, not necessarily to your passion.
Yeah, and I think this is something that, we all see it. We all see people trying to pursue their passion because they're told, I need to pursue my passion. What am I really passionate about? And what ends up happening is they get lost in this loop in their head where they don't know what they're passionate about. And I think that Iseman is trying to say, hey, just simplify it down. Instead of trying to find your passion and then pursue it with everything, like if your passion is firing off model rockets, fine. Like that's an awesome hobby. That's really cool. But that doesn't have to be your career.
Right.
Instead, choose a career path that suits your attributes and what else it is, and your strengths. And I think that just makes a lot of sense. And I think you want to do something that suits you well. I mean, you can be incredibly passionate about singing, but may have a terrible, terrible voice. Like that's not going to be a good career path for you.
Right.
So you need to instead focus on what are your strengths. If you are a great singer, then more power to you. Pursue that, but definitely try to pursue something in keeping with that.
Yep. I really like that one a lot because I've seen it, especially with these millennials. I mean, it's on the one part, it is kind of tough to self-evaluate on some of those things. Let's say you want to be a singer and you think you're really good and nobody ever really tells you. Guess what? Maybe find out something else to do. And then on the other part too, being, I think there's a trend towards identifying yourself with what your career is, and kind of having a difficulty separating that work-life balance. And you can be really passionate about something as a hobby, and almost be identified more from that than what your career is. But I like that play to your attributes and strengths a lot. All right, we got one more from Kahneman. When you have the chance to use an algorithm, you should train people in a way that creates uniformity in how they make judgments. Real big on the algorithms, huh?
Yeah, he says that artificial intelligence is a huge, huge benefit to society, but it's also going to be incredibly disruptive. He claims that it has been proven that algorithms that study radiological scans have better detection and better ultimate judgment than radiologists, which I thought was very interesting. And I think that it's something that we like to defer to human judgment. I think that's a natural human bias that we like to have. Said so-and-so is the quote-unquote expert. We need to get their opinion and defer to the judgment. But Kahneman's point is that judgment is incredibly, incredibly noisy. He says that algorithms beat human judgment 50% of the time, and the other 50% of the time, they're the same. And he says in a very, very small number of cases, humans can win, but that's very, very small.
Right.
And I think this kind of flies in the face of this trend toward almost this diversity of thinking. Instead of having this diversity of thinking, have the thinking that's right. Because ultimately, in what we're talking about, whether it's medicine, or whether it's finance, or whether it's law, there's one right answer, ultimately.
Yep.
And you want the best chance of getting to that right answer. And his point is, the way to do that is have an algorithm, have a process. It doesn't have to be a computer, but have a certain process whereby you can consistently make judgments. Because otherwise, judgments are just as noisy as the people that are making them.
Right.
So he's also said, train people uniformly so that you can also have uniform judgments.
Yeah, I like that because that steers it a little more away from interpretation and more into kind of a mechanical, let's get it right every time almost. And yeah, I've never really encountered a problem with something uniform as far as a process goes. Usually you get into trouble when there is no process in place. So I think that's important.
Exactly. And he brought up one example referencing something else, but so when he was in Israel, he was commissioned along with another faction of teachers to build a curriculum for, I think it was a math curriculum. And he and his compadres got together and got really excited about it, and they felt like they were making good progress. They were a few chapters in. and he said, just taking a straw poll, when do you guys think we're going to get this finished? And they all kind of said, and including him, they said, we're making really good progress, but want to be conservative, probably like a year and a half, maybe 2.5 years, somewhere in that 2-year time frame. It's like, okay, yeah, I'm thinking about the same. So he goes and he talks to some other people, and he asks, how long did it take you to build this curriculum? And they said, well, the ones that finished took about 8.5 years.
Wow.
And so he goes back and he's like, they said 8.5 years, and like those are only a small percentage of the people who actually started, because a large percentage actually didn't even finish. And he says, yeah, but we're going to do fine. They never finished.
Of course.
And his point is, there are going to be exceptions to the rule, but there is a case for optimism, because optimism really drives capitalism. Without optimists, you wouldn't have people investing and taking risks and contributing to society. But at the same time, on an individual basis, you want to you need to be cognizant of what are the odds here and how are you going to make decisions based off of them.
All right, so we covered a lot of stuff. What we're going to do is we're going to have a few more videos, and we're going to break down some more specifics. We have a lot of content. I mean, you experienced quite a bit over there. So let's just, for this video, to close this one out, why don't you give us at least one other little anecdote of your time in Hong Kong, and what was an interesting thing you learned?
Well, one of the interesting things that I learned was how expensive the real estate is there. And people will have a 200 square foot apartment, 200 square feet, 20
Wow.
foot by 10 feet. Okay.
Yikes.
And they're paying $1,700 US a month.
Jeez.
And even not a prime location.
Yeah.
One guy at the conference, and I don't know, I can't even tell if he was being glib or if he was being serious, but they have these micro flats now, which are just, I guess, extremely tiny apartments. And he said that one of them, the size of a Tesla,
Jeez.
just sold for $1 million.
You could probably get a bigger room on an Amtrak train going for an 8-hour train ride.
It's absolutely unbelievable, because on one hand you do see there's still a decent amount of, I wouldn't even say poverty, but there are some, I mean, it's a big city. There are some slums. Right. But on the other hand, you have just an immense amount of wealth, because you have, I mean, it's a huge financial hub. It's really the gateway to China, because Hong Kong thinks it's separate. China thinks it's part of China.
Right.
So it's really kind of the financial gateway to China. Has huge harbor and ports and everything. So you're loading all of those intermodal, those big carts onto the ships. And it's an island. I mean, it's almost like San Francisco in terms of things are just so bottled into such a small area that the price and the buildings just continue to go up.
Yeah.
And there was also a note in the conference that one of the guys said that he said Hong Kong real estate actually didn't have a big down move when the global financial crisis hit in 2008. Companies are still moving to that area, and a lot of multinational companies moving there. So there are a ton of people there. People are continuing to move there. 15% tax rate.
Wow.
So it's an attractive place from that standpoint, and good internet coverage. I believe I didn't have data there, but the Wi-Fi was reasonably quick. The transportation was fairly good. You had the subway, which was incredibly crowded. I took it at rush hour, and the subways were coming like every 45 seconds.
Wow.
Going to the same place. So
you probably got thousands getting on each of those trains.
Oh,
right?
I was in the fourth wave. I couldn't even fit on the train for the first 3 waves.
Wow.
There were that many people on the subway and then waiting to get on the subway. So you have that, but then you also have a good ferry system. You have a good bus system. But what was most interesting is that above the vast majority of the roads in downtown Hong Kong there's almost like you have the sidewalk, but above the sidewalk you have this very wide bridge almost. and it's almost just a raised platform where pedestrians can walk.
Okay.
And so you never really have to cross a street because you're just walking on this raised platform all through the city.
Right.
And you can walk to the mall, you can walk to the conference center, you can walk all over the place just on this raised platform. I thought that was pretty cool.
That is the sidewalk highway.
Exactly.
Not bad. All right. Well, thanks, Ben. A lot of good content. We're going to come back at you in a couple more days with a few different videos. We'll dive in a little deeper into some of the specifics of the conference, maybe go over a few of those keynotes in a little more depth. That's it for today. Thanks for listening to The Investing Podcast. Greg Moyer and Ben Nye signing off. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.